There's a lot of ways that you can pick stocks as an individual investor. In today's video, we'll be talking about how you can pick stocks that will actually make you money. Let's jump straight into it. The first thing that we need to do is to determine our investing goals. Not every investor is looking to accomplish the same thing with their money. Young investors are likely more interested to increase their portfolio as much as possible over the long term. Older investors are more likely to preserve their capital as they near their retirement age and they want to live off their holdings. Other investors might be interested in regular income where they will be living off their dividends or distributions. Before we go ahead, take a minute to think about your investing goals. There's no set rules and you can be in your 60s and you want to grow your portfolio with growth stocks, or you can be in your 20s or your 30s and you want to generate an extra income. Your goals will ultimately dictate which companies you should buy. Investors looking for an income will likely look at dividend stocks that has a lot of cash flow and a stable earnings potential to be able to support the dividend yields. Investors looking for growth might be interested in younger companies where their revenue looks promising but their earnings might not be as stable. Those interested in capital preservation might look in the opposite direction. This is where we invest in businesses that has been trading for decades and produces steady profits. The second thing that you need to do is to find companies you understand. When you buy a stock, you become a partial owner of a business. If you don't understand the business you're investing in, you're setting yourself up for failure. Would you trust yourself to take full control of a business that you don't understand at all? Probably not, and this is why it's so important to understand the companies that you invest in. Even if you appoint great management, if you don't understand the company, how are you supposed to know if they're doing a good job or not? You can find companies to invest in anywhere and everywhere. Every day you use products and services, and just take a moment to think about the company behind that product or service. Also consider companies that might be impacting you indirectly. Most businesses don't ever deal with consumers directly. When you go to a supermarket and pay for your goods, just try to think about who makes the machine that actually takes your payment. When you take your car to a mechanic, try to think what equipment they use and where they get their spare parts. When your cell phone signal drops, who's responsible to maintain that signal? Who actually builds and maintains the cell phone towers? This is the way that we need to start thinking of products and services that we use daily. We can use the companies we encounter each and every day as a jumping off point. From there, we can research various sectors and compare companies to each other to determine whether it's a sector that we want to invest in. If we don't understand how a company makes money, we might need to do more research, or we should find a company that we actually understand. I personally only invest in companies where I understand their business model and I understand how they generate an income. The third step is to determine whether a company has a competitive advantage. Now that you're considering a bunch of companies and their competitors, it's time to narrow down the list. The most important thing to look for in a company is a long-term competitive advantage, also known as a moat. The key to investing in a great company is not determining how great an impact it has on society, but rather whether it has a long-term competitive advantage. Companies with a sustainable moat are the ones that will be able to produce rewards to their investors. A moat can come from several different sources. Learning about how factors such as scale, unique brand, switching cost, or intellectual property helps a company to have a competitive advantage above their competitors will help you to determine whether you should invest in that company or not. A long-term competitive advantage is what sets great companies aside from average companies. We only want to invest in companies that can make us a lot of money, and this is a really crucial step to investing in individual stocks. The fourth thing that we need to do is to determine a fair price for the stock. After narrowing down the list of companies that you want to invest in, it's now time to determine what we are willing to pay for this stock. There's a lot of ways to evaluate whether a company's current stock price is fair, undervalued, or overvalued. The first thing we can look at is price to earnings ratio. The PE ratio takes a company's share price and divides it by its earnings per share over the last year. Investors can look for a company that is trading below the historic average PE ratio, and this can be a great indication or a starting point whether a company is overvalued or undervalued. It's also important to compare PE ratios to companies in the same sector. For example, we won't compare a company's PE ratio like a technology company to a company that's in the financial sector. A company's PE ratio can be higher for several reasons, but usually it's because a lot of growth is expected in the coming years. This basically means that investors are willing to pay more dollar per profit. Just remember that stock prices are determined by future expectations, and the past is only a rough guide. The next ratio we'll be talking about is called the current ratio, also known as the asset test. This is where we test the ability of a company to determine whether they can pay off their near-term debt. The ratio is basically current assets divided by current liabilities. Any number above 1 is a good ratio, and this means that the company is liquid and they will be able to pay off their near-term debt. If a company can't pay their near-term debt, if something bad happens like the COVID pandemic, that may result in a company going bankrupt, and we don't want to invest in companies that might go bankrupt. Another way that we can determine a fair price for a stock is to use the discounted cash flow model. If you really want to get into the weeds, dig into a company's financials and start making projections for future growth, revenue, and profit margins. Also, be sure to project expenses for several years. Then use this projected earnings and expenses to create a model to determine a future value. Discount those cash flows with your required rate of return, and this will help you to estimate the stock's value. Divide those by the shares outstanding, and this will give you a reasonable stock price. The next thing we can look at is called the dividend yield. If you are focused on income stocks, the dividend yield is another metric that's important to focus on. If a company's dividend yield is above the average, this might indicate that the stock is trading at a good price. However, be sure not to fall into a dividend yield trap. A high dividend yield doesn't necessarily mean that you're investing in a good company. Just make sure that you don't fall into the dividend trap and that the company has an unsustainable dividend. Go back and look at the company's history and see whether they've been paying a dividend consistently for the past decade or two. If this is the case, you might be investing in a company that has sustainable growth and can actually sustain their dividend yield. Number 5 is to buy a stock with a margin of safety. The last step to picking a good stock is to pay less for the company that it's actually worth. And this is a really important thing to consider before investing in a stock. You might be investing in a company that's really good and has a lot of earnings and profit each and every year, but you are buying the company at an overvalued price. This means that you have no margin of safety, and when the stock price goes down, the chances are that you might lose money in the short term. Instead, we want to buy a company with a margin of safety, and we want to buy at a share price below its actual value. When using the previous ratios, we can determine what the value of a company is and whether it's a fair value, and ultimately we want to buy below the fair value. This just means that when the stock goes down, we have a margin of safety, and in the short term, we won't lose money. It's up to you to determine what margin of safety you want to implement, and it might be from 10% until 30% depending on the stock that you are investing in. It's not always possible to get the lowest price for a stock, and this is where it's important to trust yourself and to know that you did the research in that specific company and that you are willing to pay that specific price, and that you know the price will go up in the long term. You never want to pay more for something that it's actually worth. And this is what's happening with a lot of tech stocks today, where people pay super inflated stock prices for companies that are generally not able to provide that amount of profit. If you follow the above steps and make sure you diversify in your portfolio, you are sure to make money in the near future. Just be sure to do your research, and everything that I mentioned above is just an indication and a starting point for you to start investing. Go the extra mile and research all of the above mentioned steps, and make sure that you understand each and every one. With that said, thank you guys for watching. That's all for today's video. I know this was a long video, but hopefully this will point you in the right direction to start investing in good companies that will make you a lot of money. If you like this video, subscribe to my channel, click the notification bell so that you'll be notified when I post new videos. Share this with your friends and family, and I'll see you guys next time.